I think the reason is that the primary buyer of physical gold is still foreign central banks. Not your audience, not my audience, not Moz and Paz, but foreign central banks. You'll notice that right after the move, pardon me, right after the news, gold didn't rally because the retail buyer had bought ahead of time. The retail buyer had a look at the impending rate cut and said this would be good for gold. And when gold happened, at least for 2 weeks or so, that buying had been used up. But the foreign central banks, people who have to allocate billions of dollars in savings, looked at this and said, this is another nail in the coffin of the US Treasury market. And that's too dramatic a phrase. But this weakens the competitiveness of the US Treasury market. As we've seen really for at least 5 years, it has been disintermediation from US Treasuries into gold that has been responsible for the strength of gold. And that's continuing.
Gold's underlying strength continues to surprise even seasoned market watchers, but the fundamental drivers aren't retail investors. The quiet force reshaping this market is the steady accumulation by foreign central banks. As treasuries lose competitiveness and real yields remain profoundly negative, billions of dollars in global savings are shifting from U.S. debt into hard assets. Gold may seem volatile, but beneath that turbulence lies a simple truth. The dollar's purchasing power is in long-term decline, and precious metals are its beneficiaries. Despite the sharp rallies and corrections, the early stages of a generational bull market are unfolding, one that mirrors the seismic moves of the 1970s. RickRule, a veteran investor with over 5 decades of experience in natural resources and precious metals, explains why the allocation to gold and mining shares remains historically small. At just 0.5% of U.S. savings and investment assets, the sector sits far below its long-term average of 2%. A simple reversion to that mean could unleash a fourfold increase in demand, while even modest institutional participation could ignite prices far beyond today's levels. For Rule, gold isn't just an asset, it's both protection and opportunity. Now, we present the clips from RickRule's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Gold historically is extremely volatile. I think that the underlying trend in gold is up because I believe that the underlying trend in the purchasing power of the US dollar is down. But we've come very far, very fast. People who can't tolerate volatility need to consider taking some profits. I have no problem with volatility. I love volatility. I've been a beneficiary of it and a victim of it for 50 years, so it comes with the territory. If you ask me where we are in the gold bull market, really, I think we're very early on. I liken this to the decade of the 1970s. As we've discussed in earlier interviews, Danny, I believe it's likely that the US dollar loses ultimately 50 to 75% of its purchasing power in the next 10 years. Not relative to other currencies, but absolutely. The consequence of that is that I think gold trades higher. The shot that we've seen very recently, I think, is an advanced market indicator of the fact that investors and savers worldwide are very concerned about the impact of an interest rate reduction in the US. A widely telegraphed trade and gold moved anyway. As the market digests that news, it wouldn't surprise me at all, given the near-term overcrowded nature of the short dollar trade, to see gold sideways to down. But if you have a 2-year time frame, a 5-year time frame, or a 10-year time frame, I think gold goes much higher. I think the reason is that the primary buyer of physical gold is still foreign central banks. Not your audience, not my audience, not Moz and Paz, but foreign central banks. You'll notice that right after the move, pardon me, right after the news, gold didn't rally because the retail buyer had bought ahead of time. The retail buyer had a look at the impending rate cut and said this would be good for gold. And when gold happened, at least for 2 weeks or so, that buying had been used up. But the foreign central banks, people who have to allocate billions of dollars in savings, looked at this and said, this is another nail in the coffin of the US Treasury market. And that's too dramatic a phrase. But this weakens the competitiveness of the US Treasury market. And as we've seen really for at least 5 years, it has been disintermediation from US Treasuries into gold that has been responsible for the strength of gold. And that's continuing. A soft economy on a global basis often stimulates quantitative easing, which is a fancy way of saying counterfeiting. The government response to a soft economy is often printing phony currency, which is good for gold. It doesn't always happen, but you bring up an interesting point in that it's likely that speculators and investors with a strong constitution need to begin to allocating substantially more resources in the oil space, which is hated or at least ignored. Um, Investors who are more momentum oriented and traders definitely want to be in the gold space because now you're in the way of the money. And it's worthy to note that although the gold trade is attractive to you and I, given where we've been, most investors can't spell gold. It is not a crowded trade if the crowd that you're talking about is the generalist investor. The generalist investor, as is evidenced by money flows into gold oriented and gold equities oriented ETFs, is still very constrained. The gold equities ETFs are increasing in net asset value because the gold price is going up. In fact, they're experiencing a negative flow of funds. So this is a story that likely has legs, albeit it's a story that's going to be very volatile. JP Morgan's Chase said that the overall, the global allocation to precious metals and precious metals equities in the US was only 0.5%. Put specifically, 0.5% of the total savings and investment assets in the United States are allocated to precious metals and precious metals equities. Mm-hmm. That's down from a 4-decade mean of 2%. So if the allocation merely reverted to mean, you would have a 4-fold increase in demand. Mm-hmm. I have no idea what a 20% market share, which would be a 40-fold increase in the allocation, would do. I don't think it will occur, to be honest with you. I don't think a 20% allocation, given what I see to be the certainty, the inevitability of a decline in US dollar purchasing power, combined with artificially low interest rates. I don't think in that circumstance that a 20% allocation is out of line. Think about the arithmetic of the competing instrument, which is certainly the US 10-year Treasury. If inflation continues at its current pace, and by the way, inflation should not be measured by the CPI. If inflation maintains its current pace, which I think is closer to 8%, and the interest on the US 10-year Treasury stays at 4.5%, what that means is that gold's competing instrument, the US 10-year Treasury, guarantees that you will lose the delta between inflation and the interest it pays, which is to say 3.5% a year for 10 years. In other words, in the US 10-year Treasury, you're guaranteed by the US government that you will lose between 35 and 40% of your purchasing power over 10 years. That's pretty constructive for gold. So that 20% number is a very interesting number. I don't think it has a hope in hell of occurring, but I wouldn't necessarily discourage it, particularly given what I consider to be the certainty of challenges around the US dollar maintaining its absolute purchasing power over the next 10 years, which I consider the probability of to be nil. Brand name for gold. Mm-hmm. My allocation to gold and gold equities is higher than 20%, but that's partially because of my economic prejudice and partially because I've spent 50 years coming to understand the gold bull market. For me, it's at once an investment, a speculation, and a vocation. I do all those things. I wouldn't encourage your audience, most of whom have lives, to be as over allocated to gold and natural resources as I am. But that's what I do. If you have a listener who owns a plumbing company, he or she focuses a lot of their life on running a plumbing company. In addition to being a philosophical adherent to gold, my plumbing company is a gold financial services business. So I'm way over allocated relative to the norm in precious metals and resources.
The gold market may have rallied strongly, but by historical standards, participation remains remarkably low. Central banks have been the dominant buyers, while retail flows into ETFs only began in earnest about 20 weeks ago. According to JP Morgan, precious metals still account for less than half of 1% of U.S. savings and investment assets, a fraction of the 4-decade mean of 2%. A simple reversion to that average would imply a fourfold increase in demand, signaling that this bull market is still in its early innings. At the same time, the U.S. faces an unprecedented debt trap. With over $37 trillion in on-balance sheet liabilities and $130 trillion in off-balance sheet entitlements, against just $5 trillion in federal revenue, the only feasible path forward is to debase the dollar. Inflation already erodes purchasing power far beyond the official CPI, closer to 8% annually, while Treasuries yield just 4.5%. That arithmetic guarantees long-term losses for savers locked into bonds. Historically, such conditions have ushered in the most powerful gold bull markets, as seen in the 1970s. With the dollar's trajectory clear, the case for gold remains compelling. Let's get back to the interview.
The anti-U.S. dollar trade is a very crowded trade, but the gold trade is surprisingly uncrowded. We have seen a real increase in the gold price, largely due to foreign central bank buying. The flow of retail funds into gold, as measured by the ETFs, didn't really start until 20 weeks ago. J.P. Morgan Chase said as recently as 6 months ago that the market share of precious metals and precious metals-related securities is less than 0.5%, which is to suggest that gold occupies less than 0.5% of American portfolios. The 4-decade mean market share of precious metals is 2%. Should gold's market share revert to mean, that would suggest a fourfold increase in interest. So while I take your point about the increase in the gold price, I would suggest to you that relative to other gold bull markets, we're in relatively early innings. I would further suggest to your listeners that they consider gold in the context of the prospects for the advancement of the U.S. dollar. If they are happy with the level of debt and deficits in the United States, if they're happy with U.S. governance, if they're happy with the prospect that the purchasing power of the U.S. dollar might increase, or at least slow down less rapidly, then they should sell their gold. Unfortunately, for myself, I don't share those sentiments. I think that $130 trillion in off-balance sheet entitlement liabilities and $37 trillion in on-balance sheet liabilities, put into reference against a $5 trillion gross federal income, tells me that the only way out of our debt trap is to debase the U.S. dollar. The consequence of that is that I see the dollar, quote, at least in U.S. dollars, increasing. By the way, I don't think the U.S. dollar will do badly relative to other currencies. I think they'll do badly too. I think that the U.S. dollar will do badly in absolute terms. The U.S. government would have you believe that the deterioration of the purchasing power of the U.S. dollar is measured by the CPI, which I think I mentioned on your show in January as the CPI. It's not a cost of living index. When I measure the increase in the price of the basket of goods and services that I consume, granted, I'm a fat old cheapskate who doesn't buy much, it would appear to me that my purchasing power is declining at about 8% compounded. If you compare that with the yield on the U.S. 10-year Treasury, about 4.5%, that means that they're paying me 4.5% in a currency where the purchasing power is declining by 8%, which is to say that they're costing me 3.5% of my wealth every year for 10 years. That makes gold look pretty attractive. If I can hold my own, rather than losing 3.5% real compounded, that looks like a good alternative. And I think that's precisely what people are seeing. I'm old enough, Amber, to remember the early part of the decade of the 70s, the last time that the deterioration in the purchasing power of the U.S. dollar was greatly greater, than the yield on U.S. 10-year Treasuries, which is to say the last time that U.S. dollar savings really, truly didn't work. And that ushered off the greatest gold bull market of my career. For many of the few buyers who were in the gold space, there is some risk on. There is a whole group of speculators who think the fact that the gold price has gone from 2,200 to 3,700 is good. An old school guy like me thinks that the price of something being 50% higher means it's 50% worse. I don't want to take the bait about technology valuations is because, as you suggest, I stay in my own lane. I don't know how to spell or pronounce NVIDIA, never mind analyze it. So describing it or Microsoft as the rest of those or the rest of those things as expensive or cheap isn't something that I can do. The U.S. budget, or for that matter, the Canadian federal budget, if you all ever have one, is something that
coming in November.
I'm much better placed to comment on. Those are big numbers that don't involve much technology. I'm cognizant of the fact that market breadth in the broad market is terrifyingly narrow. The gains of the S&P 500 are basically a function of 7 or 8 large cap technology stocks. The consequence of that is that I can't say whether the S&P 500 is overvalued or not, given that so much of the concentration is in names I don't understand. I can say that the broad economy would seem to be faltering. Certainly, I see that in my country. I see reasonably strong jobs growth, but I see the jobs growth being sort of a barbell, which is to say enormous labor shortages in highly skilled occupations and lots of job formation in service industries that don't pay living wages, and real stagnation in the middle, which is, I think, problematic. I'm not an economist, but it would appear to me that some of the economic growth that we hope to get from the increased efficiency due to technology will begin to be constrained because of an incredible and partially, by the way, deliberately implemented constriction on labor. As an example, in my country, the cessation of the HB1 visa, which is one of the dumbest decisions I've ever heard of out of government. And at the same time, the jobs growth in jobs that can't sustain a living wage. I think the economy, at least in my country, is somewhat weaker than is broadly imagined. I would suggest if we have a 9-inning game that we're in inning 3. Let me explain that to you. No, I'm not going to give you a price target. I'm old enough not to fall for that bait. But let me tell you this. In the decade of the 1970s, the U.S. dollar lost, according to the Congressional Budget Office, 75% of its purchasing power over 10 years. During that same period, the gold price ran 30-fold. Now, I'm not suggesting to you that the gold price is going to run 30-fold, having already run 12-fold since the year 2000. But I am suggesting that the U.S. dollar will again, in the next 10 years, lose 75% of its purchasing power. Really bullish. I would suspect that it is likely that in real terms, the gold price stays constant, which would suggest in nominal terms that its rise mirrors the decline in the U.S. dollar. Ergo, a 75% decline in the purchasing power of the U.S. dollar over 10 years should likely result in a nominal gold price increase that is 3- or 4-fold over 10 years.
The financial system is at a structural breaking point, and gold is no longer just a defensive asset. It's a necessary foundation. When a market begins to shift from marginal recognition to broad acceptance, the transformation can be rapid and unforgiving. We've seen this before in other cycles, where years of quiet accumulation suddenly give way to explosive price action, leaving latecomers scrambling. The current environment is setting the stage for precisely that type of transition. The debt overhang, the erosion of real yields, and the steady loss of confidence in fiat currencies are not temporary distortions. They are permanent features of a system that has overreached. History shows that in such periods, wealth does not vanish. It simply rotates. Those positioned early in tangible stores of value, like gold, are the ones who preserve and often multiply their capital when paper promises are inevitably repriced. That is why today is not about chasing headlines or timing perfection. It is about understanding the long-term arc of where we are headed and ensuring your portfolio reflects that reality. The opportunity is still here, but windows in financial markets rarely stay open indefinitely. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.